Hello everyone, and welcome back to the channel. Today we're diving deep into one of the most popular and versatile technical indicators out there, Bollinger Bands. By the end of this video, you'll know exactly what they are, how to read them, and how to use them to find powerful entry and exit points. We'll even walk through some real chart examples on TradingView. So grab a notebook and let's get started. First things first, what are Bollinger Bands? Developed by John Bollinger in the 1980s, they are a type of trading band or envelope. The middle line is a simple moving average, usually set at 20 periods. The upper and lower bands are then plotted at a standard deviation away from this middle line, typically to standard deviations. Think of it like this. The middle band shows the average price over a certain period, while the upper and lower bands create a dynamic channel around the price, showing us what's considered high or low on a relative basis. So why is this useful? Bollinger Bands help us measure market volatility. When the market is quiet and there's not much price movement, the bands will contract or squeeze together. This often signals that a period of high volatility is just around the corner. It's like the market is taking a deep breath before making a big move. Conversely, when the market is volatile, with big price swings, the bands will expand or move further apart. This tells us that the current trend might be getting overextended and could be due for a pause or a reversal. Understanding this squeeze and expand cycle is the first key to mastering Bollinger Bands. When you add Bollinger Bands to your TradingView chart, you'll see these three lines wrapping around the price action. If the price is consistently trading above the middle band, it suggests an uptrend. If it's consistently below, it suggests a downtrend. The upper and lower bands are our volatility and potential overbought or oversold levels. When it touches the lower band, it might be considered oversold. But, and this is a huge but, do I just sell every time the price hits the upper band, or buy every time it hits the lower band? That's a common mistake that we're going to learn how to avoid. It's all about context. One of the most powerful strategies is the Bollinger Band squeeze. As we mentioned, when the bands get very narrow, it's a sign that volatility has dried up and a significant price move is likely coming. The question is, in which direction? The squeeze itself doesn't tell us the direction, but it prepares us. To trade this, you wait for the squeeze. Then you look for a breakout. If the price breaks decisively above the upper band, it's a bullish signal to go long. If it breaks below the lower band, it's a bearish signal to go short. Let's look at an example. Here on this daily chart, you can see the bands getting really tight for several days. The price is just moving sideways in a narrow range. This is our squeeze. Then we see this strong green candle close firmly outside the upper band. This is our entry signal for a long position. So where do we place our stop loss? A good spot would be just below the middle band or below the low of the breakout candle. For our take profit, we could target a previous resistance level, or we could trail our stop up, perhaps using the middle band as our guide, and ride the trend until it shows signs of weakening. The key is to wait for a confirmed breakout, not just a little poke outside the bands. Another great strategy is using Bollinger Bands for trend trading. This is often called walking the bands. In a strong uptrend, you'll often see the price repeatedly touching or walking along the upper Bollinger Band. So if you see a stock in a clear uptrend, with price action above the 20-period moving average, you can look for entry opportunities when the price pulls back to test that middle band. Let's find an example. Here's a chart in a beautiful uptrend. Notice how the price is consistently staying in the upper half of the Bollinger Bands, right between the middle and upper lines. So our entry would be as the price tests the middle band and shows a sign of bouncing, like a bullish candlestick pattern. Our stop loss would go just below the recent swing low or below the lower band for extra safety. For our take profit, we can ride the trend. As long as the price continues to walk the band, we stay in the trade. We would only consider exiting if the price breaks and closes below the middle band, signaling a potential change in trend. The same logic applies in reverse for a downtrend. Now let's talk about what not to do. It's a very common mistake, is to think of the bands as absolute support and resistance. Traders see the price hit the upper band and immediately short it, thinking it has to reverse. But in a strong trend, the price can walk the band for a long time, and you'll just get stopped out repeatedly. Remember, touching the upper band isn't necessarily a sell signal. It's a sign of strength. The context of the overall trend is crucial. Always ask yourself, is the market trending or is it ranging? The strategies you use will be different for each. In a ranging market, buying at the lower band and selling at the upper band can work well. In a trending market, you want to trade with the trend, using the bands to find pullback entries. Let's refine this a bit further by combining Bollinger Bands with another indicator, like the Relative Strength Index or RSI. Let's go back to the idea of buying at the lower band. Instead of just buying every time the price touches it, let's add an RSI filter. We will only consider a buy signal if the price touches the lower Bollinger Band and the RSI is in the oversold territory, which is typically below 30. This combination gives us a much higher probability setup. It tells us that not only is the price at a relative low according to the bands, but momentum is also oversold and potentially due for a bounce. It's still around 50, not oversold at all. This is a low-quality signal and we would ignore it. Now look over here. The price hits the lower band again, but this time the RSI is down at 25. This is a much better signal. We can enter a long position here with a stop loss below the recent low. Our take profit target could be the middle band or even the upper band if the bounce is strong. Using an indicator like RSI to confirm the signals from Bollinger Bands helps filter out a lot of the noise and leads to more disciplined trading. Another powerful concept is divergence. If the price makes a new high and touches the upper band, but the RSI makes a lower high, that's bearish divergence. These multi-indicator strategies are where the real power of technical analysis comes to life. The key strategies we discussed are the Bollinger Band squeeze for breakout trading and walking the bands for trend following. Never use Bollinger Bands in isolation. Combining them with other tools like the RSI for confirmation will significantly improve your results. The standard settings of 20 periods and 2 standard deviations are a great starting point. Practice is key. Open up your TradingView account, add Bollinger Bands to your charts, and just observe. Go back in time and see how the price reacted to the bands. See if you can spot the squeezes, the breakouts, and the trend-following opportunities we talked about. The more you look at charts, the more intuitive it will become. Trading is a skill that takes time to develop, so be patient with yourself and focus on the process. Thank you so much for watching. I hope this detailed guide to Bollinger Bands was helpful. If you got value from this video, please give it a thumbs up. And do not forget to subscribe to the channel and hit that notification bell so you do not miss our future trading tutorials. Trade safe, and I'll see you in the next video.